Hi everyone, hope you guys are all having a great day today, and in today's video I'm going to cover the whole entire market in terms of Dow Jones, Nasdaq, and S&P 500, including the economic calendar. Now I do post these videos up daily, so I highly encourage you to double check the latest video on my channel so that way you get the most up-to-date information. And before I get to the technical analysis and the economic calendar, Jerome Powell basically and the Fed stated that they're going to cut the interest rates by 50 basis points and that more is on the way. It's kind of shocked the markets because from the last speech that Jerome Powell had, he basically indicated and basically said for the most part that it's going to be most likely 25 basis points. He didn't shut down the idea of 50 basis points, but basically pointed to 25 basis points. And then after the inflation data came out after that speech, the market pretty much solidified that in their minds, basically 80 to 85%, that it's basically going to be 25 basis points, even though they were kind of optimistic that 50 basis points was still on the table. And mind you, it wasn't 100% that they were expecting 25 basis points, but more for the fact that they were expecting 25 basis points. So it's kind of shocking that the Fed decided to cut 50 basis points after they were kind of indicating more so for Jerome Powell that it was going to be 25 basis points. And then they shocked the markets with the 50, even though the market was expecting 25. The benefit is technically the markets could react to the upside, as we saw massive jumps to the upside and massive pull downs to the downside. Short-term wise, we could end up heading higher. Now, indications are for the longer term somewhat pointing to the downside, but I'm thinking, in my opinion, that we're going to head to a certain level I'm going to show and then start pulling down. The reason I'm stating this is because, yes, technically lower interest rates does stimulate the economy. Technically it does. The only problem is the markets might interpret it, because I think that's the reason why we had massive spike ups to the upside and massive spike ups to the downside. It's kind of difficult to interpret it fully because the problem is if they're cutting rate cuts this aggressively, then technically it could be an indication to markets that the economy is not as great as we might perceive it to be or as we're being told, right? And technically what from Jerome Powell stated is the reason why they're cutting a little bit aggressive is to be ahead of the curve as opposed to reacting to when it comes. So if the economy starts dipping, they say the economy's strong, but they say if it starts dipping, they don't want to be behind and then cutting interest rates. So they want to be ahead of the curve. The only problem is it kind of it delays things, not necessarily delays things, but for example, this could affect housing, right? And housing is a difficult thing to combat, as Jerome Powell kind of almost seemed like from his tone that could be one potential issue. In the long term, it will get solved. But then everything else, the difficulty part about it is inflation is not at the 2% target, but Jerome Powell stated that they're confident they'll still get to the 2% target. But then again, from the last inflation data report, the reason why the market was expecting 25 versus 50 basis points is because inflation it went up slightly, right? Slightly. So because of that, you would assume it would be 25 versus 50. So the question is, what is going on, right? And I don't think the market is very clear on for sure what direction it should go, but I'm going to show some levels. But first, over the economic calendar, on Thursday, September 19th, 2024 at 8:30 a.m. we have initial jobless claims, and as well as Philadelphia Fed manufacturing survey. And at 10 a.m. we have existing home sales as well as U.S. leading economic indicators. And then in terms of levels, what I want to show is, for example, the S&P and the Dow Jones are pretty much in the all-time high zones, hovering, give or take, creating all new all-time highs. So here's the SPY ETF for the S&P 500. You can see we're at all-time high zones, pretty much the area. And mind you, we have an upward trend resistance line dating back since 2010. Doesn't mean that the market's not going higher. It is. It's just every time it goes up to the resistance level, it gets knocked down. The Nasdaq's a little bit different. I'm going to show that. But technically, if you think we're headed to more upside, then we do have a lot more room to grow technically. But there's been times we've been in the middle zone, we still get knocked down, right? So it doesn't mean you have to go all the way up to start getting knocked down. You get knocked down at any time. But before I get to the additional indications, the Dow Jones, same thing, all-time highs, right? And the Dow Jones is a little bit different. It doesn't have a clear channel, but we're at all-time highs. The only one that's different, and in my opinion, this could be a level that could be indicating when we're going to start heading down potentially, is the Nasdaq. Now for the Nasdaq, I'm looking at ETF QQQ, which is the ETF for Nasdaq, same thing, just different ratio. And it also has the upward trend resistance level dating back since 2010. Again, mind you, the market was still going up. It doesn't mean it's not going up, it just gets knocked down. Broke through since 2020 to 2022, came back underneath, had issues passing the upward trend resistance level in 2010, dating back from 2010, got knocked down, and then broke through in July of 2024 of this year. All of them, Dow Jones, Nasdaq, and S&P, created new all-time highs as of recent in July. And then now the S&P and Dow Jones are creating new all-time highs in September. It's just Nasdaq did not, and I'm going to zoom in, show one quick thing. So basically in the 3-month chart, you can see right by here, here's the upward trend resistance line dating back since 2010. and we are not at that level. And here was the July all-time high. Again, the S&P and the Dow Jones passed the July of 2024 all-time high. The Nasdaq is not the only one, is the only one that did not pass the all-time high. But in my opinion, because we're within the zone of resistance that keeps showing, in my opinion, the upward trend resistance line dating back to 2010 is the level that potentially the market could go up to. So therefore, the S&P and Dow Jones still are going to be creating new all-time highs, hypothetically. And I'm going to show basically devil's advocate in terms of that theory, because some of the indications are pulling to the downside, and I'm going to show those too. But technically, if the Nasdaq continues to the upside, I think that's when hypothetically the markets could start heading down in terms of the principle of if the Feds are cutting interest rates, because they're expected to cut 2 more interest rates within this year and so on and so forth, and multiple interest rates cuts next year. So it's a lot of cuts coming in, right? And they're pretty much getting a little bit aggressive with the rate cuts, hypothetically. But at the same time, they're saying they're reacting. They don't want to react to the bad economy coming up. They want to be proactive, basically, in a way. But essentially, if you're looking at ETF QQQ, ETF for Nasdaq, closed at $471.44, and the level you would be expecting, hypothetically, with the upward trend resistance line would be somewhere between the ballpark of $489. Now, mind you, the longer we take to hit this upward trend resistance level, the higher the high will be. So if we hit it, for example, it just depends basically, but anywhere between $488 to $490 for the time being, $490. Now we could have a false breakout, and then hypothetically it gets pulled back down. So we could easily go to, like, for example, $491, break through the upward trend resistance level, and it seems like we're probably going to go even higher, but then it gets pulled down, and then we start dipping down. So within that range, I think the market could be going higher, because again, that 50 basis points technically is a catalyst, because it's meant to help the economy, stimulate the economy, right? Again, the way it works is basically the cheaper the borrowing rate becomes, companies tend to borrow money because they expect better returns. And if they borrow money, they usually tend to invest in their business. That's what's the purpose of borrowing money. And then therefore they hire more people, more people with money, et cetera, spending, so on and so forth. The economy gets stimulated, and we're off to the races, basically, because then companies basically get more revenue because there's more buyers out there that have more accessible funds, right? So in theory, it does help out the economy. It's just the problem is the market might try to anticipate, okay, what's going on here? Is the economy not as stable as we're being told, so on and so forth, and then a dip happens, right? But that dip is just not necessarily short term. It will be recovered at one point. It's not like it won't be recovered. And we've seen it in time anyway, like the markets, it tends to go up anyway regardless, right? That is if you believe in the economy in terms of the US economy and so on and so forth. But so there's that level. So in the meantime, while we're getting up to this upward trend resistance level, by the way, it's not going to just be a straight line. It could literally take all the way till, like, for example, end of October, so on and so forth, all that stuff. By the time we hit it, then I think we're going to start heading down. In the meantime, the S&P 500 and the Dow Jones will be pretty much creating all-time highs and so on and so forth. Now, the problem is, this is the issue. For pretty much almost all of them, especially the S&P 500 and Nasdaq, the Dow Jones is a little bit different, but S&P, the 1-year chart, this is the 1-year chart, and this is the MACD line. In case you're new to the channel, MACD lines indicate if we're in a bearish or bullish movement. And mind you, we are in the bullish movement, but as of today, it pretty much started arching down a little bit. Now, it could be because obviously the massive volatility swing in terms of downside by the end of the closing day. So we'll pretty much know more of a better direction the next trading day to find out. But we've had 2 pretty much red candles, red ticks, and it could be starting to head down hypothetically if you're looking at the 1-year chart. And then the Nasdaq as well, same thing, 2 red candles starting to arch down. Mind you, both of them were not arching down before Wednesday's trading day. So now that's just new development. But the Dow Jones is the only one that's kind of still showing upside, but I will say it is somewhat starting to curve down a little bit for the 1 year. We have 2 red candles as well, but there's no real reflection on the MACD line fully for the downside. But the Dow Jones, mind you, it's only 30 companies versus, like, for example, 500 for the S&P, right? And then if we go to the 5-year chart for the Dow Jones, still kind of showing upside regardless. So again, this is the reason why I'm expecting the S&P and the Dow Jones potentially for the most part to go up. Not necessarily as strong. For example, the Dow Jones could be a lot stronger for the upside versus the S&P, but I still think we're not expecting a massive pull yet until, in my opinion, by this is just all my opinion, please do your own due diligence and research before buying and selling, until we hit the upward trend resistance line. Do we have to hit it to come down? No, we don't have to, but I think that might be the case because, again, that 50 basis points versus the 25 that we were expecting, technically it is a catalyst to the upside. Technically, it's supposed to stimulate the economy. It's supposed to, right? And then here's the Nasdaq 5-year chart. it's still showing somewhat of a curve to the downside. So in my opinion, like the downside pull could be near. That's what I'm seeing it as. And the S&P, same thing, 5-year chart technically could be arching down, so the downside could be near. And then the alt chart is pretty much, all of them are pretty much the same. They're somewhat of a 50-50 pull down slash like middle. And then here's Nasdaq, somewhat pull down middle, and then here's the Dow Jones, arguably middle. So it's pretty much, we have to see in the next few trading days to find out how the market's perceiving the rate cuts and the information data points that are coming through. But that's basically it for today's video. If you found it beneficial, consider dropping a like. It does help out the channel, so thank you so much for that. I do appreciate it. And if you want to be notified when I do upload my next videos, consider following, subscribing, so be notified when I do upload them. And thanks again for watching. Take care, God bless, and peace.